Will Omicron crash the markets? It's a simple question, but it's one that's been reverberating around markets globally. There's been a lot of discussion about it. We saw a significant sell-off and quite a rapid move to the downside over this past period. Volatility has risen, the VIX has peaked above that 30 mark, and the question is, what happens from here? Is the Omicron variant and potential further lockdowns going to hamper growth? Are we at risk of an economic slowdown and a potential crash to the downside? Or really, what does this all mean for markets? Today, we're going to discuss these questions, as well as some of the other contributing factors in the broader macroeconomic landscape. We'll have a bit of a look at where things currently stand as we head into the back end of 2021 and look forward to the new year in 2022. If you do enjoy this video, don't forget to hit the like button. If you're new here, welcome. We make new videos each and every day, so if you haven't yet, make sure you've subscribed and turn your bell notifications on as well, so you won't miss any of our daily episodes. And so I think before exploring the nuances of the different pieces of news that have really come to light over this past period, it makes sense for us to take that step back and have a think about what are the big issues? What are those key pillars that analysts and investors are looking for at the moment? First and foremost, the virus. We know there's been a bit of a resurgence in some areas in Europe. U.S cases are rising as well, and of course Omicron is another different factor to contend with. But on the other side of the coin, there are then other contributing factors that are really making investors sit up and really take notice about, okay, where will things head from here? Not only on the back of potential hampering of growth, but the monetary policy setting that's currently setting the tone for the rest of the market. We know about inflation. We know there's been labor shortages in key areas of the economy. We know about the supply chain difficulties that have led to price pressures into the input costs as well. But on the other side too, monetary policy. We just recently had the U.S CPI print. There was all eyes on this one for November, but most importantly, what it will potentially feed into the decision as the Federal Reserve meets next week for the final meeting of 2021, and about the pace of the potential taper, and then ultimately what it could mean for interest rates over this next few years as well. I'm keen to know your thoughts on it all too, so drop in a comment below what your thoughts are on Omicron and the state of the rest of the economy. Where do you think things head from here moving forward? So starting at the top, Omicron. By now, I'm sure everyone's familiar with the Omicron variant. We saw what the Delta variant did to the economy and the lockdowns that came as a result of that. So there were fears initially about Omicron. Of course, it looks like it is quite viral in nature and has high levels of transmissibility. And on the news of it, we saw Omicron actually really drive the worst Black Friday sell-off since the 1930s. There was a sharp, swift sell-off into that weekend. And really distilling it down to the key fear. What is the uncertainty? It's the fact that there could be potentially lower growth, which would trickle through and disrupt the economy both on an employment level with the downside risks to that, as well as broader economic activity. We saw the effect of extended lockdowns on growth. Many nations around the world over this past period, including Australia, had negative GDP figures for the past quarter because of the lockdowns that affected the economy. And there still is such a broad range of outcomes. We're waiting for more news to come to market about Omicron. How lethal is it potentially? And then of course, we know many of these big pharma companies are also currently seeking alternatives, running tests and getting assessments about whether current vaccinations will work for the Omicron variant. So that's where the eyes are. However, I think it is worth noting that yes, volatility has returned over this past period. We know markets dislike uncertainty. There's been a bit of a sell first and ask questions later approach to this Omicron variant because of the potential risk to the downside if it does evolve negatively. However, I think it is worth noting as well that last year, the lockdowns, though they were major, the virus was significant. What was the driving force behind markets over this period? Ultimately, it's really been driven by monetary policy. We know markets have been awash with abundant liquidity. There's been very accommodative monetary policy settings, as well as coordinated fiscal stimulus as well, which has meant that despite the lockdowns, despite the virus, the economic recovery has actually been robust. Household savings rates have risen. Despite everything that's been playing out, rising inflation as well, consumption has not actually declined, and we've still seen really strong consumption across nations around the world. But the reason why inflation is such a big discussion at the moment is, of course, as inflation rises, central banks have to look for tools to combat that. Initially, the taper to really try and reduce some of the liquidity in the system, but ultimately raising of interest rates and returning back to more normalized monetary settings is where things will go. The question is, at what pace, at what velocity will we head back to more normalized settings? And the uncertainty about the virus is whether another virus wave, we've just got through Delta, whether that would be inflationary or deflationary. It's really difficult to tell at this stage. We just got the U.S CPI print for November. As you can see by the visual on the right, CPI year on year is above that 6% mark, came in just about on consensus. Markets actually rose on the back of it, probably because it had priced in a very high print already. We know inflation's running hot. The fear was if there was a 7 handle in front of it, what would that actually mean for the markets? But it came in just about on consensus. But as you can see here, it's been the hottest print in around 40 years. Interestingly, we know that many of the key drivers for this current bout of inflation have been global supply chain pressures, which should ease over time as mobility returns, as borders open up, and as things get back to more normalized conditions. However, Jerome Powell, the Federal Chair, has stated over this past week, he went slightly more hawkish, and it was actually coincided with the Omicron sell-off, which probably led to a bit of a steeper pullback than was anticipated. But Jerome Powell said it was probably time to start retiring the word transitory, and provided indications that they may speed the taper as well, which really is what investors are looking for over this next period. With the Federal Reserve due to meet on December 14th and 15th, that's when we're going to get more insights about the pathway up ahead. And so with all of that context, all of that backdrop, you might be wondering, why is it such a big deal? As we mentioned, eventually we have to return to normalized policy settings. Over this past period, we've been in emergency crisis settings because there was a global pandemic. It was an emergency, but we have to reset the policy settings so that if future economic shocks happen, if future black swan events happen, we have the tools available to combat those. We can't stay in these emergency crisis settings permanently. It's interesting to think about coming out of the GFC, obviously, there was low rates, there was a significant and expansive quantitative easing program as well, but there were some notable periods over that time. In 2013, we had the taper tantrum when the former Federal Reserve Chairman Ben Bernanke came out and started discussing potentially slowing down the taper. We saw what happened to the bond market in that period. There was a swift sell-off as well in the equity market, but that taper tantrum has really stung clearly in many of the Federal Reserve's decisions over this past period because they know they have to get the messaging right, the wording right, and the timing right with it all. We know there was a bit of volatility and uncertainty as rate hikes began as well in 2016. And then, of course, just quite recently at the back end of 2018, we know there was a broad market pullback as well. There was 4 rate rises in 2018. And so notably, the Federal Reserve and central banks around the world are aware about how important messaging is, how important the timing with it all is, and they want to avoid any sort of taper tantrum. It's inevitable that there could be wobbles. We know volatility is heightened and will likely remain heightened with the uncertainty that comes up. But the focus for now is really on setting the trajectory and a clear pathway to give the economic recovery the best chance of being sustained moving forward over this next period. It is worth noting as well that due to heightened inflation, the Federal Reserve does have less optionality. Of course, you can't just have another expansive quantitative easing program, say if there's a virus and lockdowns. As a result of, you can't really move the rates too much lower. There is negative rates, but that's a conversation for another time. But it is also worth noting on the other side of the coin too, that the current economic state is underpinned by a robust economic recovery. Yes, the low interest rates and significant liquidity has kept markets and other asset types buoyant, but there has been a robust economic recovery and the household consumer has been spending rapidly with pent-up demand at the opportunities when the economy has opened up. And so the question is, where to from here? What are investors? What are analysts? What is the market looking for over this next period? Firstly, if you have enjoyed this video, don't forget to hit the like button. Feel free to share it out. And a big thank you to everyone who's subscribed and turned their bell notifications on. You won't miss any of our daily episodes. We know that at the moment, the quantitative easing program is expansive. It's $120 billion per month of assets being purchased. But the taper or the wind down has commenced. At this stage, it's tracking at about $15 billion a month, and that should end in the middle of 2022. But the discussion now is, with these record high inflations over this past period, do we need to now start to consider a speeding up of the taper? That's what a lot of the eyes will be on over this next week with the next Federal Reserve meeting. We know the Fed aren't planning on raising rates until the taper is complete, so they want to get this taper out of the way, and then they can focus on having a bit more optionality in terms of timing, depending on how the economic data flows through. And this meeting on December 14th and 15th will be that next discussion point. It's going to be important. There's going to be a lot of different takeaways, so keen to hear what plays out. I'd love to know your thoughts on it all, so drop in a comment below what you're looking for and where do you think the economy heads. This past period, we've done a range of different videos on the channel, so we'll leave links to those up above as well if you are interested in those ones. Thank you so much for joining us. Hope you enjoyed the video. It's a fascinating period on markets as we head into the back end of the year. For now, stay well and happy investing.